Hello friends, in this video we'll be speaking something on the process of securitization of an asset, an overview. You see, there is a very renowned professor from IIMS who is speaking on the same subject on the given YouTube link. You can refer it in case you have further doubts. So let's start with this concept of asset securitization. You see, this is actually a process of transformation of a financial asset, which is actually a blocked asset, means where trading is not easy, into another security which is actually tradable in nature. Means, you see, let's go back into history. What we did it is we have a discussion on when loans are given to people. Every loan is not going to be good. Some loan will be bad. Some loan will be a blocked asset. These blocked assets don't have any marketability. When you take bad loan to someone, no one would be happy to buy it. But you see, so we need to give some opportunity to these bankers that they do have some way out from NPA. So you see, what we need to do is like NPA, which is actually a blocked asset, needs to be converted into another form of security which is tradable in nature, where people, some of the investors, they are willing to actually invest. So this process is called as securitization. Let's discuss it further. So former chairperson of Citibank, Mr. John S. Reed, he has defined asset securitization as the process of substitution of more efficient public capital for less efficient, higher cost financial intermediaries in the funding of debt instrument. Okay, so you see, he has defined it that like when one party is get is willing to get rid of this type of instrument, there is another party who is ready and is willing to invest in such securities. This chart is telling you about traditional banking. What happens is like banking is done by people who have surplus money. Here in this case, it is actually a party who is willing to get loan. So borrowers are supposed to approach a bank. So when a borrower is approaching a lending institution, what they do is like they looking into the credibility of a borrower. You see capital, collateral, condition, capacity, and you see character. So these are some of the parameters on which borrower is being evaluated, and if he fits in into all these criterias, he will be given a loan. So now you see, whenever you are given a loan, next comes is from where are you going to bring it? Once your loan is sanctioned, means you should have funds. So from where it is going to come in? It is coming from depositors' money. Okay, another set of clients who are depositors, they are going to give money. This money is used for lending purpose. Lending process is involving a scrutiny process through which we validate the credential of a client, and if he is fitting in, we will give the loan. Now, you see, next is like you see, you need to ensure that these loans are timely repaid by clients. So, monthly installment or annual installments, whatever is your tenure or type of loan, like you see in any normal loan, you'll have monthly repayment. But in case of a gold loan, you see, you try to pay in lump sum after completion of 1 year, or you can pay it as and when you have your funds. So, you see, servicing of loan means you are making repayments in the form of interest and principal partly paid throughout the tenure of loan. Then you see, after this particular dimension of servicing the loan, you have some concept of monitoring of loan. Monitoring means authority should be there, especially bank and their software who are monitoring all these customer accounts to ensure that nothing is going out of control, is within staying within the limits. Now you see, in this case of securitization, what happens is like now the lending institution, when they have given a loan, is actually an instrument. Okay, it is through an instrument they are lending it. Now let's say I bundle 500 to 1000 loan accounts in one go. They all are related to mortgage, let's say real estate loans given to different parties. So I bundle it up in one go. So now this bundling of security which is done is according to the quality of asset. It can be according to the quantum of asset, it may be according to the class. So this is going to be a tougher call. So in securitization, what we do is like we bundle these loans together. So when it is bundled up together, you see, these can be the various rationals. It can be like home loan, it can be automobile loan section in one side bundled up together, corporate loans can be bundled up together, credit loans, credit card loans can be given in one bundle. So you see, your bundle is actually a reflection of a particular type of asset class. Okay, so maybe on certain trades they are getting bundled up, and then you see, once they are bundled up, these are long-term commitments. Loans are usually for long period, except for credit card. You see, all these loans are for long-term period, so they do have an element of interest rate risk. So who is bearing it? Bank is bearing it. So can it be possible we delegate this thing to someone else? Depositor holders' money is stuck in these loans for a long period, and you do have an element of interest rate. A bank is bearing it. So in order to like avoid this, we can go into the process of securitization. What we can do is like we can bundle these securities and can sell it to potential buyers. So in this case, big fund owners like insurance companies, pension fund, they may come as a potential buyer of this bundle, and then they may be interested in getting these regular returns and then making a lump sum payment in advance. Now what will happen is like when these buyers, potential buyers, new buyers are entering into this particular instrument, bank will be taking an exit. Okay, as a owner, bank is going to take an exit. So bank's rights are transferred to these special investor category. But what bank is going to do is going to still there in this relationship as a facilitator. So their role is to recover the interest and pay it to the concerned stakeholders. Like let's say they are acting as a collection agent and a facilitator. They'll collect it from the various borrowers and will remit at periodic interval to the potential new set of owners. Okay, so who are willing to get themselves into this particular case of an exposure. This exposure is related to liquidity, it is related to interest rate risk. So they are willing to take. So accordingly, you see, this process of securitization will be initiated. Now we'll have my next follow video, which will tell you the various traits which are very important in securitization. So we'll try to see that thing also. For the moment, take care. Good day.